Hey team, this is Luke. I'm going to be your tour guide today for Bayesville Posterior Predictive Levels. Quick background on myself. I'm a finance professor and I've been a consultant in industry for over 30 years. I've been lucky to work with some of the world's biggest and best companies like Morningstar, MMR, Oracle, Salesforce, Pepsi, and a bunch of others. Now, what I'm doing here is taking some of my work I do with institutions and bringing it down to retail, so we all have access to the same types of tools. What are PPLs? Well, they're posterior predictive levels, and I use Bayesian learning algorithms to develop them. I've also merged that with AI recently to help speed up some of the calculations. Now, first off, I would tell you to look at PPLs as you would any other support and resistance level. You're going to take profits on longs heading into resistance and accumulate long positions into support. However, these PPLs are 3 dimensions. And what that means is I'm looking at these probabilities of success as a function of price, time, and probability of significance. If you want to learn more about that, then watch my full-length instructional video on PPLs where I actually run one of these live for you. Now, PPLs are calculated using optimization algorithms and a bunch of math. Now, through this dynamic stochastic optimization process, the support and resistance levels are racked and stacked based on the probability of success. I identify 2 resistance levels above current price and 2 support levels below current price. Now, given the nature of the PPL search algorithm, I'm searching out into the future and back towards the present. I'm also able to identify tipping points in price action. What does that mean? It means that, let's say, a particular ETF or stock that you're following, the price is moving up and heads into resistance. If it is able to clear that resistance, that then increases the rate of change of probabilities of that particular stock or ETF accelerating to the next higher PPL. So, to recap, PPLs are support and resistance levels. They're calculated using Bayesian learning algorithms to identify the highest probability of support and resistance. And they can also be viewed as tipping points, where if you get above 1 or below 1, you can it increases the probability of accelerating to the next one. Now, why use the Bayesian PPL trading system? Well, first off, if you look at the research, the Bayesian learning methodologies have the most superior results of all technical indicators out there. Again, if you want to learn more, check out my full-length instructional video. It provides numerous high probability support and resistance levels. It's autonomous, it's optimized, and removes all biases because it's a price action only system, meaning that you might have an inclination to be a bull or a bear, but this just tracks price into and out of high probability support and resistance levels. It'll help you sort out competing viewpoints if you have those, because you're just following price. And it works extraordinarily well with whatever trading system you're currently using, because again, it's a price action only system. So basically, PPLs are merging AI with Bayesian learning algorithms to give you your competitive advantage. Now, this is the 6-step process. If you want more details, again, check out the full-length instructional video. But we're going to identify the ETF. You'll be given the PPLs and technical indicator optimal levels. You'll also be given an optimal profit-taking level and how to use all of that information to get to a Bayesian status, which is where we're actively into a trade. So step 1, you're going to find on my YouTube channel and X, which is Luke Miller, PhD, daily videos put up by one of my colleagues, and his name's Chuck. He's a great guy. And he's going to guide you on doing PPLs on a daily basis for 30-minute charts, which is swing trading for 1 to 3 days, or 2-hour charts, which is swing trading for a week or 2. Here's an example output from the Bayesian learning algorithm. Again, if you want to see one live, check out that other video. You can also see here in the bottom, these are the optimal parameters for this particular trade setup. And this is parabolic SAR, TSI, MACD, and you'll also see the profit level itemized there. You will then take those PPLs from this particular chart and you will transcribe onto your charting service of choice. This is an example from stockcharts.com. There are lots of others out there. You can see here you have the parabolic SAR, MACD, and TSI. The red line is your resistance level identified from the algorithm, and the green box is the support level. Let's get to a Bayesian status. So let's say several hours ago, the PPLs were determined, and here is a support PPL. Price action from the SLV, which is the silver ETF, finds its way into the PPL. Now once it does that, that's when we start looking at the technical indicators. Before price action hits the PPL, we're not really tracking the indicators because they don't matter yet, because we're not into a high probability support region. Now here we are into a high probability support region, our PPL, and we get a flip in parabolic SAR from a short status, where the dots are above, to a long status, where the dots are below. So we would take a third of our position, or we'll take one tranche. We'll notice that we're going to get a flip up here in TSI as well, when the black line getting above the red line. We're going to get into another tranche. That's two tranches. And then when your MACD histogram flips up, you're going to get into that third position, or your third tranche. And off you go. Another quick example here, we're heading into a PPL resistance region. So you've been waiting to short this. Here we are, price action finds its way into PPL, and we start to get flips. We get a flip in the parabolic SAR. Let's get into that tranche. Black line over the red line, headed back down. We call that a short. Let's go. Tranche 2. And here we are with the histogram. It flips back underneath. Tranche 3. Let's have some fun. Looks like this one's going to work out pretty well. Now you really have to understand your own risk tolerances and in the amount of time that you have to trade. If you can sit in front of a screen on an intraday basis, then 1 to 3 day trade system is right up your alley. Maybe the 2 hours is better for you because now we're targeting 1 to 2 weeks worth of a swing trade. But that's really for you to determine. Now, in terms of risk management, it's important to understand how much you're willing to lose per position. I'm just going to give you a rule of thumb for this particular system. Again, you might have your own way to determine your stop out levels. Generally, the rule of thumb is 3 full candles against your position. So look on the left-hand side of this chart for SLV. We went long into the PPL at 47.38. We got a gap against. Now we have 3 full candles, 1, 2, 3, 3 all consecutive in a row above our PPL level. We're out. We don't ask questions. We take our loss and we move on with our life. Keep in mind, this is a high probability trading system. It's not a 100% probability trading system. So, if you're interested in learning more about how I've combined AI plus Bayesian to build this system, or you want more specific guidance on using the PPLs for support and resistance levels, I'd encourage you to check out ElliottWaveTrader.net and Luke Miller PhD on X and on my YouTube channel, Luke Miller PhD. Thanks for hanging out, guys. We'll see you out there.